What's happening, my level 2 friends? Peter Olinto with Wiley back again. Question of the week. Good stuff here. Financial reporting and analysis. I know you love it. You know you love it. Consolidations, I'm sure, is one of your favorite topics. Full, partial. Well, that's our topic right here, all right? So let's do it together. Let's have some fun. If you got some family or friends, invite them in. They're going to love this stuff. All right. So we've got a question. It says, using the following information, answer the next two questions. Legalized cheating. Do not read these facts without knowing what to do with it. So I see something about goodwill and utilizing something called the partial goodwill method. Okay, so I'm thinking partial goodwill. That's IFRS. And IFRS gives you an option to do either partial goodwill or full goodwill. Okay, so we'll talk more about that in a second. Question number 2 talks about US GAAP. US GAAP, you have no option. You got to do something called full goodwill. Okay, so if I'm taking the exam, now that I've seen I got to calculate full goodwill, partial goodwill, I'm thinking, well, how do I set that up? So before you dive into the facts, let's regurgitate some of those formulas that are absolutely must know. So the first thing you're thinking, let's say I'm doing IFRS. And let's say I've chosen partial goodwill, then you should be thinking that both your goodwill and your non-controlling interest are going to be based on what's called the fair market value of the identifiable equity. Now, the fair market value of the identifiable equity may or may not be given. Okay, what is the fair market value of the identifiable equity? What if it's not given information? Then you're going to have to look at the target company and find for me the fair market value of all of their identifiable assets on or off the balance sheet. Okay, it's got to be given to you. Fair market value of all the target company, any asset you could identify on or off the books. Then you want to subtract from that the fair market value of all identifiable liabilities. Again, on or off the balance sheet. It doesn't matter. If it's off the balance sheet, they have to give you what would the present value of that obligation be. A common example of an off the balance sheet asset might be things like in-process R&D. But find for me the fair market value of every asset for the target company on or off the books. Subtract from that the fair market value of any liability on or off the books. And now you've calculated the fair market value of your identifiable equity, also known as net assets. Okay, so you need that number. And by the way, you need that whether you're doing US full goodwill or IFRS partial goodwill. Okay, next thing you're going to do, I need to find, was this given information? So now I'm ready to read the facts, and let's see what we got. Sterling acquires, all right, there it is, a 60% interest. As soon as you see 60% interest, you're thinking I've got control. Therefore, I've got to do a full consolidation. Now, full consolidation means that despite the fact that we're only buying 60% of the company, when we put together a consolidated balance sheet, I'm going to add 100% of the parent and subsidiaries' assets together. 100% of their liabilities get added together. And then on the consolidated balance sheet, I'll have something called non-controlling interest as part of the consolidated equity, as you'll see. Same thing when you consolidate the income statement. Despite the fact that you only bought 60% of this company, you're going to include 100% of that target company's revenue with the parent. 100% of the expenses get added together with the parent. And then we'll deduct from that really the non-controlling interest. That percent we don't own is going to be deducted on the consolidated income statement when arriving at consolidated net income. So despite the fact that we own less than 100%, we're nonetheless going to have a full consolidation. That simply means including 100% of the target company's assets, liabilities, revenues, and expenses. Okay. Our purchase price was $150,000. I always want to know, how did the parent fund this acquisition? Did they issue stock? Did they pay cash? Did they issue debt? Okay, so always be mindful because that's going to change the parent company's balance sheet. How did they fund this acquisition? Did they pay cash? If they did, then the parent company's cash goes down. If they issued stock, then the parent company's stock goes up. If they issue debt, then the the acquiring company's debt goes up. Okay, so be mindful. Doesn't apply in this question, but just want you to be thinking about that. Okay, in this question they gave us the identifiable net assets have a fair value of $225, yet the company has a fair value of $250. I'll deal with that $250 in a second. For right now, the fair market value of the identifiable equity has been given information. The purchase price for a 60% interest, given information. Now we got to process this. So I stop. Don't keep reading. It's information overload. Partial goodwill. The first thing I want to do is take my purchase price for that 60% interest. And what was that purchase price? $150,000. Okay, now I'm going to subtract from that the fair market value of the identifiable equity. How much was that again? $225,000. Now, logically, what should we have paid given that we're only buying 60% of the company? Well, $225,000 times 60%, well, that's $135,000. Logically, you would have thought, hey, the identifiable equity has a value of $225 and you're only buying 60% of the company, you would think logically, therefore, you'd pay $135. Well, you didn't. You paid $150. What the hell did you pay the extra $15,000 for? I have no idea. But we can't have an asset on a balance sheet called I have no idea. So we give it a name. We call it Goodwill, but it's actually I have no idea. So the Goodwill, the partial Goodwill, 60% of the total goodwill is therefore $15,000. Okay, there's your partial goodwill under IFRS, which obviously answers this question, which is incidental in this process, but nonetheless, there's your partial goodwill IFRS. Let's keep working with this though. Okay, next thing you would do, your non-controlling interest. How would you find your non-controlling interest? Well, if we bought 60% of the company, then obviously we do not own 40%. 40% is the non-controlling interest. That gets multiplied by the fair market value of that identifiable equity. And what was the fair market value of that identifiable equity again? $225,000. If you multiply that by 40%, what would be our non-controlling interest? $90,000. Okay, so this $15,000 of partial goodwill would appear on the consolidated balance sheet as an asset. So when you consolidate the balance sheet, this has to be inserted as an asset. This non-controlling interest would also appear on the consolidated balance sheet, part of consolidated equity. As part of your consolidated equity, you would have your non-controlling interest. By the way, as an aside, consolidated equity is always the parent equity plus the non-controlling interest. Okay, so consolidated equity is the sum of the parent standalone equity plus the non-controlling interest. When you consolidate a balance sheet, we eliminate the acquired companies' retained earnings, paid in capital, all that gets eliminated. Consolidated equity is the sum of the parent equity plus any non-controlling interest. So this is how you do it, partial goodwill. Now in this question, they say, well, what would happen to our ratios? Okay, if instead we used full goodwill. Now, US GAAP, unlike IFRS, doesn't give you an option, right? As a general rule of thumb, IFRS tends to be more flexible, right? Remember the statement of cash flow, you have options as to where you could put interest paid, right? IFRS tends to be more flexible. US GAAP is very rigid. Same thing here. You're going to consolidate, you got to do full goodwill. Okay, so let's now review how would we work this problem if we were doing US GAAP full goodwill. Okay, if you're doing US GAAP, you must do full goodwill. IFRS, you have an option, partial or full. US GAAP got to do full goodwill. Both the goodwill and the non-controlling interest are based on something called implied fair value, as if you purchased 100% of the company. So under US GAAP, full goodwill, both the goodwill and the non-controlling interest are based on something called the implied fair value, as if you had bought 100% of the company. So in this question, we paid the purchase price. The purchase price was $150,000. Okay, and that was for a 60% interest. Well, therefore, if you took 60% and you multiplied it by the implied fair value, you should get that $150,000. The implied fair value, okay, for 100% of the company. If you only bought 60%, then logically you would have paid the $150,000. So I want to solve for implied fair value. Do a little old-fashioned algebra, divide both sides by 60%. What must therefore be the implied fair value for a 100% interest? We solve for X. It's got to be $250,000. Now, in this question, that happened to be given information. That's what that $250,000 is, that quote-unquote fair value. Okay, that fair value, all right, they're talking about the implied fair value. Now, you can't count on them giving you that exam day. You got to be ready, just like we did here, to solve for that yourself. But there's the implied fair value. So step 1 under US GAAP, find the implied fair value. If it's not given, find it for a 100% interest. Okay, step 2, what do you do next? Take that implied fair value for that 100% stake in the company, $250,000. Okay, subtract from that the fair market value of the identifiable equity for a 100% stake in the company. So given information, what was the fair market value of the identifiable equity? It was only $225,000. Well, why would you then purchase it for $250,000 if the fair market value of the identifiable equity is only $225,000? Why would you pay $250,000? I don't know. What's that extra $25,000 for? I don't know. It's nothing that I can identify. It's unidentifiable. I don't know. But since we can't call it I don't know, what do we call it instead? Goodwill. So 100% of the goodwill then, 100% of that goodwill has got to be $25,000, right? There it is. So that's 100% of the goodwill. Now notice something. Notice the difference between US GAAP and IFRS. Under US GAAP, we're recording the full 100%, the full goodwill, 25. Yet under IFRS, if you chose the partial goodwill, what did we say a second ago? Partial goodwill, IFRS, we would have only recorded how much? 15,000. So notice the difference. Okay, under US GAAP, your consolidated assets are going to be higher by $10,000. Okay, your consolidated assets will be higher by $10,000. And you got a check figure here. 15,000 should be 60% of the full goodwill. So I check myself. 25,000 times 60%, is that in fact $15,000? Yes, it is. So this is 100% of the goodwill. This is only 60% of the goodwill. Alrighty, so consolidated assets, if you do the full goodwill, are going to be higher by 10,000. Okay, now step 3 under US GAAP. Now let's find our non-controlling interest. So again, if we bought only 60% of the company, then we do not own 40%. That's our non-controlling interest. Under US GAAP, both goodwill and the non-controlling interest are based upon that implied fair value. We know the implied fair value is $250,000. Take your $250,000, multiply it by 40%. What's your non-controlling interest under US GAAP? It's going to be $100,000. So under US GAAP, your non-controlling interest, which is part of your consolidated equity on a consolidated balance sheet, your non-controlling interest is going to be $100,000. Conversely, if you had chosen IFRS, partial goodwill method, your non-controlling interest would have been how much? $90,000. Remember that? IFRS, your partial goodwill, if you go back to our setup, your partial goodwill is based upon the fair market value of the identifiable equity. 225 times that 40%, $90,000. So in our question, Ready? Full goodwill method results in a non-controlling interest of 100. Partial goodwill results in a non-controlling interest of only 90. So under US GAAP, your non-controlling interest is higher by $10,000. Okay, so notice the net effect, your balance sheet. If you use the full goodwill method, your consolidated assets are higher by plus 10 because your goodwill's higher by plus 10. And your consolidated equity is also higher by $10,000. No coincidence, it's higher by $10,000. So under the full goodwill method, US GAAP, your consolidated equity is going to be the parent standalone equity, the acquiring company's equity, plus the non-controlling interest. And since our non-controlling interest is higher by $10,000, the consolidated equity is also higher by $10,000. Now that's going to affect your ratios. Okay, so now we can answer this question. So they want to know, in this particular question, if we had reported under US GAAP instead, then we know our assets, our goodwill is going to be higher by 10, and our consolidated equity is going to be higher than by 10. So when you look at your consolidated balance sheet, relatively speaking, goodwill's higher by 10, consolidated equity is higher by 10. Okay, then what would that result in? No change in equity ratios? That can't possibly be correct. If your equity is different, your ratios are going to be different. How about a higher debt to equity? Debt is exactly the same. That's not affected at all. But if your equity is higher, your debt to equity is not going to be higher. It's going to be lower. If your denominator is higher, then your debt to equity is going to be lower. It's got to be the last one. A lower total asset turnover. How do we do asset turnover? Sales divided by assets. If your assets are higher, then your asset turnover will in fact be lower. So obviously that's your correct answer. All right, but also not only the content, notice the technique. Before you get bogged down in the facts, skim your questions, legalize cheating. This way, any formulas that come to mind, you can regurgitate it, then read your facts in context. You start to feel confident. You're reading the facts, cherry picking the relevant information. You know what to do with it rather than spinning your wheels, okay? By the way, I recommend that whatever you're using to practice, even if the question only asks for partial goodwill, do that. But then also answer the question, what if it were full goodwill? Compare and contrast how that would affect your results. All righty? So that wraps up this free question, man. I hope we are earning your business. That is our goal. But regardless, I hope you got something out of this. And hopefully we'll see you again. If you choose to do another free question, we'd appreciate it. Talk to you soon. Good luck.